Everybody stand back. We got another green day in the S&P 500 and I'm going to do analysis on it.
Object to the text!
Please subscribe. This is a daily heat map of the S&P 500. It's really obvious to see what's going on in the market. Technology really took it on the chin here, both in infrastructure led by Microsoft, Nvidia in semiconductors, and then software application followed the tech trade as well to the downside. Nvidia down now actually about 13% on a peak to trough basis, and the entire box of technology following suit. Also the bigger names in each sector. Look at industrials, GE, RTX, in Home Depot, in consumer cyclicals, as well as Amazon and Tesla. But other than that, it was green across the board. Energy, very green. Same here with utilities, real estate, industrials as a whole. Same with comm services, excluding Netflix. So a very green day across the board. And there was not a whole bunch of news. I think Goolsby came out and said that if data kept coming out weak as it did this month, there definitely will be rate cuts on the table. A couple of very minor data points, but all in all, I think it was just really a rotation from semiconductors, technology, software, discretionary, really these big names into, the rest of the market. We saw rate sensitive sectors outperform here today ahead of growth. Look at stuff like XLE, regional banks, GDX, XLF, home builders, financial stocks, really rate sensitive names outperformed, and the broader market for the most part. A couple of minor sectors did take it on the chin, stuff like real estate right here and metal and minings, but inconsequential, and they still outperformed. One of them outperformed the SPY and two of them outperformed the discretionary sector, software, tech, and semiconductors. So very interesting day of trade right here. This is exactly what I said in my weekend video. I said we're probably going to see a sideways to down technology mega cap trade and then up RSP equal weight the broader market, and continue to see breadth momentum pick up in the market, which is completely healthy, completely normal. And I've been saying that for a couple of weeks. Normally the mega caps lead and then the rest of the market follow, and we saw in the last 2 to 3 weeks the mega caps really did lead the way with Nvidia, Apple, Microsoft. They really did rally while breadth deteriorated and the rest of the market fell. And now we're just seeing the catch-up trade, and that's healthy market momentum. Something else that benefited the broader market today was yields. Yields actually dropped 0.54% and continues to hover around this 4.2% and continues to hover around the 4.2% area. It does look like the high is in for now in the 10-year yield. The RSP saw quite a bit of volatility, pretty much flat for the day, up 0.08%. But have a look at this wick. At one point, the RSP was up nearly 0.8%. Mid caps and small caps gained 0.6%. And the biggest losers of the day were the S&P 500 down 0.31% and the Nasdaq 100 down 1.51%. Commodities also did support broader market price action. Crude continues to tick up. It gained 1.1% today. Silver was largely flat, gold up 0.5%, and Bitcoin absolutely tanking, down 5.11% here today. Now let's actually talk about the S&P 500, down 0.31% today. Pretty brutal day for the market as a whole. Cap weighted indices led by some of these stocks like Nvidia, Apple, and Microsoft. But there was some positivity to come out of this. Firstly, market breadth is improving in a very big way. It does look like we are probably going to go and hit some of these key levels and break some of those, improved market breadth, particularly in the RSP. It looked very strong today, particularly off the lows. But we did see a couple of concerning things in both the RSP and the S&P 500 that we really do need to talk about. The first one was actually this wick right here, okay? Even though we did see a green candle and a pretty much a flat day, we did see a lot of sellers come in at the top here to take the RSP lower, but we also saw a lot of buyers come in at the low. So very indecisive in totality. We dive into the 5-minute chart and we can definitely see that very glaring stance. You see, we actually gapped lower, then we rallied all the way up, a huge impulse move, and then that's when the bears decided to come in a very strong way. However, still slightly positive day, and we saw a very similar situation here in the S&P 500. We saw a huge impulse move on the open, and then we actually saw a sell side all the way down, except unlike the RSP, the S&P 500 actually broke the day's lows, closed at the 54.47. Now we actually are right on the gamma flip zone for the S&P 500. This is this zone right here. So the gamma flip zone is at the 54.44 level, and then the put support is at the 5300 area. So if we are to see continuation of the sell side in the S&P 500, do expect to find support, if not right here at the 5300 area. I think we're probably going to see sell side all the way to this area. We'll find support and then make our next move from there. I do favor that if we do pull back, our next move is probably going to be to the upside. Don't think we're actually going to go lower. I just think that, you know, market momentum in the RSP and in the mega caps in the market as a whole is just really, really strong at the moment. And particularly with the impulse we saw in mid caps and small caps, we're going to see a rotation in both sector and size over the next week. And if we do get better than expected GDP data, better than expected PCE data, you know, we could pull back to the 5,300 area by Thursday, Friday, and then see the huge move up. But there are risks to this market, because if we do get to this 5,300 area, let's say, and we get weaker than expected GDP, hotter than expected PCE, yeah, then we could definitely move lower. So a lot's going to depend on the macro, particularly with earnings season out of the way. The market's going to move based on the macro and the technicals. And we do know that the macro data has come in particularly weak. We just have to see how the market assesses weak data being cool versus weak data being the economy falling apart. So definitely we're going to keep a close eye on the GDP and PCE data. That being said, as it is right now, if we do look at price action, you know, we are in an uptrend. We don't want to fight the trend. We just want to buy dips on the way down. And the first area of support that we want to look at for the S&P 500 is this 5,300 area. If we don't actually like consolidate and then continue the impulse move here, I mean, you know, tomorrow mega caps could be green, RSP could be green. We could have a very, very green day, break all-time highs in the S&P 500, and then it's just onward and upward from there. And what I'm trying to say here is, if we do pull back, this is the first zone that we really want to look at in the S&P 500. Other than that, the price action we're seeing is actually been rather healthy. If we actually, you know, pull up something like the relative strength index, you can see we've worked off quite a bit of these overbought conditions. Maybe if we continue to trend down and or sideways, we can see continuation of these overbought conditions being worked off. And then we also see stuff like market breadth improving. Very, very healthy trade when you look at this in totality. Just because the market was red today doesn't mean it was actually bad. In fact, the market being red today, the cap weighted being red today, was actually more of a positive than it was a negative for the broader market as a whole. And as long as we find support at this 5,300 area, you know, I think the market's going to continue to make new all-time highs, and it's onward and upward for the month of July. And if we do get a move up in the gamma flip zone to the 5,600 area, then we do know what our next key level to attack is in the month of July, and then it's onward and upward from there. So 5,300, that's what we're going to look to right now, and also see what happens in the gamma tape. Those are the two things I'll be watching this week. Those are the two things you should be watching this week, and I'll keep you guys updated on everything here. So go ahead, subscribe so you don't miss a beat.
Now let's talk about sentiment. This is BOFA's bull bear indicator. It actually rose from last week to 6 from the 6th position, so things still looking bullish according to BOFA's bull bear indicator. We can also see a very similar situation here in Goldman Sachs sentiment indicator. Not much has changed. I say it every single week. The sentiment right now is just hold equities, because the market is going to go higher, but we could be in a period of digestion. We could pull back a little bit. You just want to sit through the volatility, because higher prices will ensue. These indicators are not yet in this massively overbought positioning. I know the Goldman Sachs sentiment indicator says stretch positioning, but it can definitely go higher to as high as 2. I've seen it as high as 2.5. So there's definitely more gas left here in the tank. Now let's actually talk about earnings, because this is ultimately what the gas is. Now forward expectations here for earnings growth. This is large cap and small cap indices. Now this is by FactSet, I believe. And we can actually see that right here, 2024 earnings for small caps is set to be 4.1%, S&P 500 12%. So this is large caps. Then in 2025, we actually see small caps outpace large caps at 17.7 and outpace them by a large margin, and then 14.2% here for the S&P 500. And then we've actually finally got 2026 earnings, and we are looking at 12.5% growth here in small caps, 11.9% growth here in large caps. So slight deceleration here in growth from the small cap side as well as large caps, but still double-digit growth. Now we do know what 2024, 25, 26 is going to look like, but what about the second quarter? Now, this is what FactSet believes earnings will look like for the second quarter 2024. Now earnings growth for the second quarter 2024, they estimate growth to be at 8.8%, which will be the highest year-over-year earnings growth rate reported since Q1 2022. Very interesting. Earnings revisions on March 31st, the estimated earnings growth rate for the S&P 500 for the second quarter was 9% compared to now, which is 8%, right? So very, very slight earnings revisions. 7 sectors are expected to report lower earnings today due to downward revisions in EPS, and that is 7 out of 11. There's 11 S&P 500 sectors. Earnings guidance for Q2 2024, 67 S&P 500 companies have issued negative EPS guidance. 44 have issued positive EPS guidance. What about the remaining 400? Very weird. And then looking at the overall results for earnings so far for Q2 2024, 10 companies have reported actual results. 6 have reported positive EPS surprises and 4 have reported positive revenue surprises. Very, very interesting. So very, very early look here. Things looking fairly positive for the second quarter. Now, where does that leave us with valuation regarding earnings? Now, right now, the S&P 500 trades at a PE of 21.2, a PEG of 1.2, a free cash flow yield of 3.2%, a 5x price to book, 16 times EV to EBITDA, and 3.2 EV to sales. This compares to every other sector right here. The cheapest sector being energy on almost every single metric, trading at a 6.7% free cash flow yield. Kind of nuts when you look at that, and 11.7 PE. The most expensive being information technology, now trading at a 30 times forward, but a 1.4 PEG, which is actually the best sector here apart from consumer discretionary and financials and com services. And then you also have infotech trading at a 2.4 free cash flow yield. So, you know, real pricey on a bunch of other metrics excluding growth. So cheap on growth, expensive on relative value terms. But this compares to something like com services, which is trading at a 19 PE, 1.1 times PEG, 4.9 times free cash flow. So essentially by buying something like the com services sector, you're getting more money up front, you're getting better growth than the average in the tech industry, and you're getting it for a cheaper price relative to its earnings. Far better value here in com services with growth. I would also look at stuff like healthcare. Look at that PEG, very, very healthy PEG, healthy PE ratio, and also not a bad free cash flow yield. A lot left to be desired there, but compared to tech, 2.4%, very, very attractive. So I still find healthcare, com services probably the most attractive sectors. But if you are looking for, like, you know, deep value, absolute value, you want to look at energy, you want to look at financials, trading at very attractive PEs. While the S&P 500 does trade at quite a pricey PE, it has to do with stuff like tech, discretionary. Every other sector actually looks relatively fairly valued or undervalued, all things considered. Now let's actually talk about the economy. Now we got a really great note here from BOFA. So let's go ahead and read. The probability of no landing grows by the day. We update and extend our outlook through 2026. The US economy is cooling, but not cool. The economy is benefiting from a positive supply shock and elevated labor demand from the services sector. The US has avoided a hard landing, and we expect that to continue through the end of 2026. So we're starting to see earnings come in for 2026 and growth expectations to continue into 2026. Now, growth to moderate, but consumer to remain resilient. Growth should moderate towards 2% as the catch-up effect in employment fades and the contribution from fiscal and business investment slows. That said, we see enough resiliency in the consumer to keep the economy in a solid expansion. The catch-up effect in employment to extend into 2025. We think the catch-up effect in services employment can last into mid to late 2025. We forecast average monthly payrolls to gain 216K in 2024, 156K in 2025, and 125K in 2026. We project the unemployment rate to peak at 4.2% and remain near 5-decade lows. Inflation, turbulence on the descent. The US had a scare on inflation in early 2024, but recent data has reaffirmed disinflation as the base case. That said, inflation is seeing demand side effects through greater employment and spending. We do not project a return to 2% until 2026, and we have some of the charts here. You can see they both expect inflation to cool gradually and the employment rate to slightly drift up to the 4.2% range. And that is on the back of non-farm payroll growth of 216,000 per month in 2024, 156 in 2025, and 125,000 in 2026. So diving into gamma, the core resistance is still at this 5,500 area right here. The put support at 5,300, so still a fairly tight range, a 200-point range from peak to trough, if you want to call it that. The gamma flip zone is still at 54.45 right here, so we are officially in the window of weakness. You can definitely see quite a lot of gamma has actually rolled off the tape. We are still positioned at this 5,500 strike, and it doesn't look like the other strikes are yet to build out, but we are seeing quite a bit of negative gamma form here on the tape. So guys, we are still in the window of weakness, which means Vanna and Charm are still on holiday. So throughout this next week, we just want to see where the gamma flip zone repositions. And then when July starts right here at the end of the month in the first week, once we get these Vanna and Charm flows back, then we see where the gamma flip zone, where the core resistance, where the put support has officially repositioned itself. And we start building gamma into the first week, into the second week, here into OPEX week in July. Then we can start making definite plays to certain key levels. But as it is right now, we're still buying dips, selling rips to the 5,500. But because the gamma flip zone is here at 54.45, if we do get below it, we could definitely see some sell side weakness where dealers will actually sell into weakness and buy into strength. So, anything
anything below 54.45 could definitely see material weakness to as low as the 5300 area. So do be aware there's definitely some risk in this market, particularly when the gamma flip gets very close to the core resistance. That's often a sign that the market does want to pull back in a material way. And we did kind of see that trade today.
Now let's talk a bit about seasonality here in the fourth year of a presidential cycle. So normally we actually see returns of 12.2% in a presidential cycle, and this is what we've done so far here in 2024. Very, very interesting. So we are tracking well above seasonality, but it doesn't matter about the level. What's important is actually the trend, and based on the current seasonal trend, it looks like we are expecting very linear returns in the S&P 500. Now that does not mean we can't pull back. We definitely can, but I do expect higher price action in the S&P 500, and I expect the price action to look something like this for the rest of the year, where we will go ahead and eventually make highs. Now where do we dip in terms of this? I think we should see a dip here in the September into October, anywhere in this period right here. It could go into early November, it could start as late August, but I think somewhere in the September October time period we're going to see quite a substantial dip in the S&P 500. The bears are going to get excited, then we're going to rip their faces off into the end of the year. Now guys, tomorrow we have earnings, so we're going to take a look at Carnival Corp here tomorrow on Tuesday, as well as FedEx. Then for the rest of the week we have Paychex, Micron, and then Nike on Wednesday and Thursday, so do be prepared for that. On Wednesday after the close we also have BlackBerry, Levi's, Concentrix, and Jeffries right here. So a stacked earnings here on Wednesday. On Thursday we have Nike, couple big names, but we're going to tackle all of these. And we also have quite the data this week. We have GDP that's coming out on the 27th. We also have the presidential debate that's on the 27th as well, and then we have PCE data here. These are the expectations. So we're looking at headline month over month of 0%, year over year 2.6%, and then the core component 0.1% month over month, and then 2.6%. That is the headline figure. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.